Let's get more on the markets. We're joined by Jack Janasiewicz. He is lead portfolio strategist at Natixis Investment Managers Solutions. Thanks very much indeed for coming on the show.
Thanks for having me.
What is your feeling? Are we actually into this Goldilocks scenario where the economy is growing at just the right pace?
You know, I think when you look at the fundamental backdrop, it certainly seems that way. You know, we're getting plenty of signs that the labor market is, on the wage front specifically, is beginning to slow. And we're still at the same time seeing growth numbers still holding up fairly well if you look at some of the ancillary indicators around the economy. So with that backdrop, there's plenty of signs that inflation is going to continue to ease. It feels like, and it looks like there's still plenty of pent-up disinflation in the pipelines to come through. And we're still seeing growth backdrop numbers holding up. So to that Goldilocks comment, it certainly seems like that could be easily what plays out for the second half of this year.
I mean, you hear skeptics say, well, the Fed always manages to overturn the economy, but they might get away with it this time?
Yeah, and it certainly seems like that. And maybe Powell might actually get some of the credit that is due for that potential soft landing scenario. I know he's been taking quite a bit of abuse, it seems, in the press for potentially mishandling some of this stuff with some of the, the poor telegraphing late to the game, so to speak. But, if we step back and look at the bigger picture backdrop, it certainly seems like the odds of that soft landing are continuing to increase by the day.
You have an interesting point here that we're all about, we've got to bring down inflation. But disinflation in some ways is bad for corporate profits.
And that potentially could be one of the key things that we keep hearing about for the concerns going forward, something that may potentially derail that optimistic outlook for the second half of the year, right? The bear case narrative right now certainly seems to be residing around the idea that disinflation will basically hurt that top line revenue growth going forward. And as a result, because that top line is coming down and that sort of expense ratio, if you will, that the expense levers there will stay constant, that will end up ultimately squeezing margins. So it's something that we're paying attention to. It's something that I think when we look at what's going on with regard to second quarter earnings, we're certainly not hearing that, but that potentially could be the fly in the ointment for the second half. Not our base case, but it's something we'll be certainly paying attention to, the compression of that margin driven from top lines coming down as opposed to the expense side being crimped.
And we are seeing definite signs of disinflation in things like car prices or rentals.
And I think that's the key, because when you start to think about that disinflationary pipeline, we've started to finally see used car prices coming off the boil, so to speak. But when we look at those real-time indicators, they're certainly now in disinflation. So I think from a perspective of potential pass-through, there's still plenty of that working its way through the system. Same thing when you look at the rent side of the equation, right? We all know the methodological quirks within the BLS CPI basket and how that finally, it takes a little while for that to work its way through. You look at the real-time pricing for apartment rents, and it's certainly well off the highs. So again, a lot of reasons to remain optimistic that disinflation is still coming, and these are the sort of the indicators that we're pointing to. There's plenty still in the pipeline to come.
What about oil? Would you be putting on long positions in crude oil and oil producers right now?
Yeah, it certainly seems like we're getting a nice bounce here. We look at some of the latest numbers that are coming out, and it looks like the demand for oil is starting to pick back up. Could very well be a function of the global economy starting to pick back up again. But from that perspective, and if the broader markets, when we look at the laggards, and we're certainly seeing breadth widening out in here, those laggards, I would lump in the energy complex to that story. And so a place where maybe there's some significant underinvesting with regard to your typical investor, there could be some upside in that energy complex for the rest of the year.
What about the materials generally? I know China is the big swing factor there. Copper, for example, would you be bullish in that area, the industrial metals?
Yeah, I think there's a little bit of a trepidation, I think, for getting too bullish on that sector. We've been a little bit fooled in the past by some of the things that the market has expected with regard to that China stimulus package coming forward. It seems like we've been expecting a lot and sort of been underwhelmed time and time again. So I want to see some concrete evidence on the back of that. But the bottom line for us, China certainly seems like they might be taking a little bit of a different tack that we're used to. In this case, our base case is that, the Chinese authorities might simply try to be putting a floor under growth as opposed to actually trying to aggressively stimulate. Big difference there. And I think the aggressive stimulation, where you want to see growth accelerating, that I think would be a cause for being a little bit more optimistic on some of those metals. But if you're just putting a floor under the market, I'm not sure how aggressive we would be getting on the back of some of those base metals as well for that.